This interview is with Caleb Avery. He is the co-founder and CEO of Tild. Tild is a PayFac-as-a-Service company. We explain exactly what that means. They've raised about $30 million and they sell into software companies that then sell into businesses. So his background is all in payments. He has created a ISO, a sales organization selling merchant services or credit card payment processing. We talked about that world, what it looked like, how he at, I believe, 19 years old, he was able to grow a business with over 100 employees, selling 10,000 different businesses, or at least going door to door to 10,000 different businesses, selling them different credit card services. We talked about the trajectory of payments and what they are doing to influence that. A really exciting conversation. Caleb knows a ton about the payment industry and in particular, the payment processing segment. So I hope you enjoy and learn something as I did. Please do give us a thumbs up or share this video if you do enjoy this conversation. Here is Caleb Avery. All right, Caleb, I'm excited to chat with you more. We've been having a few minutes of great pre-show conversation, but I'd love to just kick this off with your background. You're talking about your business prior to what you're building now at Tild in the ISO world. Paint me the picture of like what ISOs are, why they're relevant in payments, and how things traditionally have been structured. And then that'll catch us up to what you guys are doing and where things go from here.
Sure. So first off, start with the acronym. So ISO being an independent sales organization, that was really where I started my career. So at 19 years old in Greenville, South Carolina, going door to door, selling payments to small business owners. And when you think about the payments ecosystem from a distribution perspective, that traditional door-to-door ISO sales model is really what the payments industry is best known for. Some would say infamous, for that side of the business. But for me, started going out door-to-door, selling payment processing services to small business owners, eventually scaled up that business to pretty sizable scale. We now have agents in all 50 states across the country. And after scaling up that business, I started consulting for software companies. And so for me, I started working with these vertical software businesses anywhere from 100 million up to about $1 billion in annual processing volume. And that shift in the industry is something that has been happening for about 10 years, but really has accelerated over the last few years. And it was working with these software companies that I really started to see a pretty significant gap in the market where a lot of them were starting talking to companies like Stripe or Braintree and just passing along the payment fees onto their customers. But at some point they reached the scale where they really wanted to start monetizing the payments flowing through their ecosystem. And that was really where I started to enter this conversation, was where these software companies wanted to start generating revenue on their payments. And it was at that point in time that these companies faced this like existential question about what direction to go with their payment processing systems. And usually most of these companies would start working with the traditional processors, the ISOs, and start to form referral relationships with these businesses. And the problem with that traditional ISO model within the software ecosystem, one, from a technology perspective, a lot of these ISOs and acquirers haven't updated their payment technology in 10, 20 years. And then from an actual merchant sign-up perspective, you're going from this instant digital Stripe boarding experience to a PDF application process. So, you can imagine for a modern software business, the last thing that they want to do is have to email their client a 10, 15 page PDF document for them to sign, print out, scan, and send back to them with all of these supporting documentations. And so it just created a really clunky experience for a lot of these vertical software businesses.
And tell me a little bit more about the industry of these ISOs. So my understanding, and help fill me in on the gaps here, is that prior to credit cards in, I think, the 80s, maybe early 90s, people used to just pay in cash. They pay in a check. And then the problem was that some people who deposited a check, the checks would bounce. And so the bank card, there's a bunch of banks that got together and said, we're going to create a debit card. And then that allows you to instantaneously check the balance of the bank account so people can't write bad checks. That was the initial impetus for it. And then it was like, hey, instead of just debit, we can do credit. And then we're going to charge. So I think they initially charged merchants to use the debit card. I think maybe they still do today. I don't know. But then they just kept that same model and charged for the credit card. And then they needed a way to sell the credit card installation, like the actual hardware terminals and the wiring and all that. And that's where the ISO, so these like groups of salespeople started to just go out because they could mark up the cost per transaction from like 2.5 to 2.7, and they could get residual income. So that is that the general structure? Am I missing anything?
Yeah, let's kind of take it all the way back to the beginning here. You think about some of the benefits of credit or debit card processing, from a merchant perspective. One, you're right. You have this instant ability to assess, whether the consumer is able to pay for the goods or services, that you're transacting. There's also confidence that you as the merchant are going to be able to receive that money into, your bank account. If they're paying by check, you're not sure if they're good for it. You're not sure if they're going to call in and, say, hey, I didn't, actually write that check. This is fraudulent. You get a returned, check. And so you have this instant confidence that's built between the merchant and the consumer. And really companies like Visa, MasterCard, Discover, Amex are that brand that instills that confidence in that transaction. But the question is, how do the card brands make sure that every merchant in America, every merchant in the world has that ability to accept, credit cards? And you're right, the ISOs have historically been that distribution channel, the feet on the street distribution model to get credit card processing into the hands of as many merchants as they can, because you've got these networks, these, Visa, MasterCard, Discover, that aren't in the business of going out and selling services to individual merchants. You as a merchant also want the ability to be able to accept all of the different payment types. So you want to be able to accept credit, you want to be able to accept debit, all the different brands, all the different debit schemes. And so you have sponsor banks that were set up that had the direct relationships to the card brands, and then you have the acquirers. And so that network of the sponsor banks and the acquirers really form the backbone of the payment processing ecosystem, and really are like the pipes that all of the transactions flow through. And then the ISOs have really been a very profitable, very scalable distribution channel for the banks, for the acquirers to get this product out into the market, at least historically. I think you're starting to see a lot of disruption with that model, but it's been an absolute cash cow for decades for anybody involved, in that side of the acquiring ecosystem.
And is this model, the referral sales model, is this what made Visa and MasterCard so successful, or had they been successful prior to this?
I do think it's a large part of it. I mean,
Yeah.
with any business, distribution is key. Like for Visa, MasterCard, they want the acceptance of, their branded cards to be ubiquitous. And so for them, there's really two sides to that equation. There's the issuing side. How do I get as many cardholders to have a Visa branded card or a MasterCard branded card in my pocket? And so that's where you see the card brands competing for relationships with the issuing banks. So, if Bank of America is going to issue a debit card or a credit card to, their millions and millions of customers, what brand is going to be, on that card? That's a big part of the equation from a revenue perspective and a distribution perspective to get that card into the hands of as many cardholders as possible. But the flip side of that coin is the acquiring side of the payments ecosystem. It's one thing to have a cardholder that has a Visa card, but if the merchant that they're going to transact at doesn't accept that Visa card, then that transaction can't take place. And so it's really this two-sided marketplace that I think for one is complex. There's a lot of regulation. It's also why you haven't seen a lot of net new players, coming into the card brand space. There's effectively a duopoly in a sense between Visa and MasterCard for dominance, especially here in the US market.
Interesting. And so why are these ISOs still relevant today? I would think once the internet comes around, the turn of the century, it's like businesses just go online, they find, wherever I imagine for them, they're thinking of it as like your credit card is just one of many things you need to set up a restaurant or an apparel store or whatever you're selling. How is it still happening today? And what does it look like today?
Yeah, I think one aspect of this that a lot of people don't think about is the customer support. side of the business. And so for you as a small business owner, you own a restaurant, that credit card terminal is probably 90+% of how you actually make a living. And so if that card machine breaks or you're having issues, with your terminal or your merchant processing service, like that is a lifeline. That is a fundamental part of how you run your business on a day-to-day basis. And, if you as a merchant want to go partner, directly with one of the major acquirers at this point in time, the customer service experience that you get, from the big guys leaves a lot to be desired. And so a big sales pitch for us in the early days with my ISO and for a lot of ISOs is this idea of like, hey, you, Mr. Merchant, if you have a problem, you text me, you call my cell phone number. We've got, 24/7 support teams. You don't have a 3-hour wait on hold, while your card machine's down during a dinner rush. And so, I think one aspect is customer support and just having the ability to provide the dedicated level of service that a lot of merchants really feel is necessary for them to be able to run their business. I think, thing two is that it really has been a very successful and very scalable way to grow for a lot of these acquirers where they've been able to set up commission only models. And so most ISO relationships are commission only sales models with the acquirers, that they partner with. And so from a scalability perspective, if I'm, the acquirer, my choices are I can build a relatively expensive in-house, W2 sales team, or I can partner on a commission only basis and you eat what you kill. And so that model has been, quite successful because I think the incentives are aligned, between the ISO who's out there, feet on the street selling, and then, with the acquirer who's sitting behind the scenes. And then I think another aspect of this is just trust and confidence. And so, from a merchant's perspective, yes, you can go online, and there's plenty of options that you can sign up for online, but do you as a business owner trust that, this unknown entity that you've never spoken with is going to be able to be trusted with what is a mission critical part of your business? And, you see brands like Stripe, brands like Square, that have been able to create that brand recognition where merchants do have confidence that, hey, if I go sign up for Square, I know what that experience, is going to look like. But it's a lot different than like I walk into that business, they see my face, they shake my hand, they're able to ask me, questions and really build the trust and relationship to get, confident in signing up for that processing service. And so I think it's been difficult for a lot of online companies to be able to bridge that gap and get, customers to be able to take that leap of faith with them to sign up, via a virtual experience, whereas it's traditionally been a very successful model to have that, door-to-door sales presence, physically speaking with merchants and helping them set up their equipment.
Yeah. So in 2022, you started the business 10 years ago, the ISO business, which now you said has hundreds of people. You've gone, you were saying earlier, to 10,000 different houses initially, build up some business, not houses, doors. So this would be doors to restaurants. And then people say yes, you start facilitating transactions, taking a percentage of those transactions, hiring other people to do the same thing and growing this enterprise. Is this, at the time, why is this interesting to you? And even then in 2012, it feels kind of late to be building. Was that actually the sweet spot to be building an ISO? Or, I mean, I would think of this like, this was like door-to-door sales for payment technology. That's probably like, I would peg it as the 80s or 90s, but to start a business, you're a young guy, started 2012, have it be as successful as it was. Are we just now in the heyday, or was that the heyday, or how do you sort of map this out time-wise?
Yeah, I guess a couple of questions in there. One, what was interesting to me, about the business, 19-year-old kid in Greenville, South Carolina, what was appealing about it to me? I think we started summer between my sophomore and junior year of college, really going out and talking to business owners, well, almost as an experiment. There wasn't initially this idea of we're going to build this massive business, in the payment space. It was almost more like, how do we build up, fear money, here over the summer, where I'd looked at getting an internship, looked at getting other jobs, and was really enticed by this idea of residual income. So one of the things that I think maybe a lot of people don't understand about the payment space, especially within the ISO model, is it's really all a residual income business. And so, businesses that I signed up in 2012 are still customers, with us today. I still get a monthly residual check, on those businesses, 10 years later. And I think that concept of building up this residual income stream was something that initially was really appealing to me. But then as I got out there and started talking with, small business owners about some of the pains that they were experiencing in the market, I really felt like it was something that we could make a meaningful difference, in these business owners' lives. And I think that's been the case. The fact that they're still customers, 10 years later, we've clearly provided, a service to their business that adds a tremendous amount of value, where the thousands of people that have walked in their door haven't been able to take, those accounts away from us. And I think as we started to scale up the business, there was an inflection point where initially it was, let's go hire all of our friends and, get them on to this model. And that was largely a disaster. But as we started to recognize that there was this opportunity to recruit experienced agents in the payment space and provide them a better overall product, a better overall experience, all of a sudden we really started to see a different level of scale within the business. And I think that inflection point was pretty exciting, just to start seeing, all of these experienced agents that have been in the payment space 5, 10, 20 years, just recognizing that we could provide them, a better overall experience than what they had before, because we were laser focused on that agent, that ISO experience as we were building up our model.
So when you were doing this, what the thing that made you, because I'm thinking it's so, in a sense, it's so prone to being commoditized, because if you're an agent, you're selling for 5 years, they're like, well, why don't I just go hire other people, right? It's kind of that, like the Tupperware model where it's, instead of selling directly, I sell it to my friends and they sell other people. And then there's like a cascading commission.
It's like a multi-level scheme,
right,
if you will,
right. And that's kind of the structure that Visa, and I'm sure these banks desire, because then that offloads the upfront costs and then provides residual downstream, and then they benefit from the network effects. Was there a massive amount of competition at the time, or did you feel you were able to like jump in and have like the competitive advantage was what in hindsight?
Yeah, it's a good question. There was a second part of your last question that I didn't quite answer, which was, was 2012 the heyday is today, the heyday? And I think that the reality is the ISO world has always been a very competitive ecosystem. The bar to actually go set up a new retail ISO is very low. Go set up an LLC, get an agreement, with one of the major, acquirers. It's pretty easy to actually go out there and start an ISO. So fundamentally, there's a significant amount of competition. In terms of, 2012 versus today, I think that the competitive landscape has changed quite a bit. And it's not even just the fact that the ISO landscape itself has gotten more competitive. I think one of the shifts that I've seen is that the software-led side of the payments ecosystem is really starting to encroach on the traditional ISO channel. And so, when I think about what was our competitive advantage at that time and what made 2012, a good time to be out there selling to small business owners, within our first couple of years of being online with the ISO one, we had the EMV shift. And so EMV being the little chip cards on your credit or debit card, that you see. And those EMV chip cards represented a pretty significant opportunity really early on in our journey, because there was such a small percentage of merchants that actually had the hardware, that actually had the technology to be able to accept chip cards within their business. And so we had this opportunity to be able to go out there and really almost every merchant in America was a potential customer for us, as well as, other ISOs, because they needed to upgrade, the equipment at their business. So that was one kind of macro tailwind that was working in our favor. Thing two, I think it was like 2014, 2015, when American Express came out with their OptBlue program. And that represented a pretty significant shift in the industry for those of us that were in payments prior to that OptBlue shift. Traditionally, merchants got a direct account with American Express. Oftentimes it was separate funding, it was separate statements, and generally, us as the ISOs and the agents did not earn revenue on the American Express transactions, which, if you're in the restaurant space, could be 30-40% of payments. And so when Amex came out with their OptBlue program, that represented a pretty significant opportunity for us, because we were able to come in here and really, for the first time, negotiate and save merchants money on their Amex, and then create a revenue opportunity for ourselves. And so those two tailwinds created a lot of momentum for us, despite quite a bit of competition in the space.
So great description. I feel like we cover the ISO background. We have the history, have how you got into it, why it was exciting, how you built it, the perspective from the bank cards and the acquiring banks. How clearly at this point you're feeling like technology is becoming more influential in the business owner's day-to-day life. Stripe comes out, Square comes out. This has to have shaped the ISO world significantly. They're feeling like, hey, this door-to-door strategy can't work forever. We're going to eventually turn into the yellow pages, and it's going to move online. Even then, to be starting a business in 2012 and have built it to the success you had is impressive, because I think of 2012 as pretty late in the game to be doing offline analog stuff. Is this kind of the pressure / opportunity you felt? And how did you sort of like carve out were there iterations on the business model, or did you just have this insight and was like, yeah, this is it?
Yeah, I think it's a good question. I think the reality from my perspective is that for a lot of ISOs, 2012, 2015, 2020, I still don't think a lot of ISOs are really feeling that pressure, really understanding how the ground is shifting underneath them, because in a lot of ways, they're still out there successfully, signing up merchants. I think for me, what shaped my experience was that I started doing consulting work for software companies. And so I kind of got out of the ISO ecosystem. And so I had a much different point of view. Whereas if I hadn't done a lot of that consulting work, I think even sitting here today, I probably still would be out there, trading up sales reps and growing that part of the business. But, probably back in, 2017 or so, I started consulting for software companies where people would reach out to me. Hey, Caleb, you're the credit card guy. I've got all these statements for this business. They're doing hundreds of millions of dollars in transactions. They have hundreds of merchants. They're not making any revenue on these payments. They have no idea how to make sense of what's going on within their business. And so I'd come in and first off, help them understand the landscape and do a lot of, what we were doing earlier on in this conversation, just helping them understand the landscape and the different options available to them. But where most of these software companies started in their journey was with Stripe or Braintree. And so, Stripe, Braintree, fantastic solutions, great developer tools, easy for you as a software company to get up and running. The problem is there's not a revenue, monetization opportunity for these software businesses. And so, a couple of years in, they've got product market fit, they've got hundreds of customers, potentially hundreds of millions of dollars. They started to look at, how do we go about monetizing the payments, flowing through these platforms. And, after doing this consulting work for a few years, I was recommending, legacy gateway solutions like NMI or Authorize.net, and then helping these guys negotiate these ISO referral agreements with the big processors. And the practical reality was that the technology available from those legacy solutions, plus this really antiquated merchant onboarding experience, was really leaving a lot of these software companies in this position where they were struggling to actually create adoption through their customer base for this integrated payment solution. And so for me, it was January of 2019 that I really felt like I had this itch that I couldn't scratch. I had this idea for this business that, January of 2019 probably couldn't have given you a super compelling pitch on exactly, what that was going to be. But I saw a pretty significant gap in the market to service these ISVs and service, these vertical software companies that, I truly believe were going to be the future of the payment distribution model, based on a lot of the work that I was doing, a lot of the trends that I was seeing. And I think 3.5 years later, you're starting to see, those macro trends playing out. My personal belief that the next, 5 years, you're going to see a pretty marked acceleration of those trends. And I certainly hope that the ISOs and agents that may be listening are starting to pay attention to some of those tailwinds because the industry is going to be changing.
Yeah. So I want to hear an example. So if I'm a business, what's the most standard case? Like a restaurant, a mid-sized restaurant. I have, I don't know, 10, 12 employees. I'm using some software. Like, what would be a typical use case for a software vendor that a merchant would use? And then,
Yeah, in the restaurant space, let's say, you as a restaurant owner have had Aloha, point of sale system for 10, 15 years. All of a sudden now you're starting to look at Toast, as an option, to run your business. And the difference with Toast, MindBody, Shopify, a lot of these software-led payments companies is that the point of sale system comes with their own integrated payment solution. And so all of a sudden, these software companies are coming in and displacing the agents, displacing the ISOs. They're not leveraging, in a lot of cases, the ISO distribution channel. They're going direct to merchants, signing them up, and then they have their own integrated payment processing solution. And so they're carving out an increasingly larger portion of the payments pie. I think today it's something like 15% of payments in the US run through, software led payments providers, where it's about 65% through the traditional channel, and the balance being e-commerce. But you're starting to see that balance shift massively in favor of these software companies. I think the existential question for ISOs, acquirers, banks, agents within the traditional payments ecosystem is, how do you respond to that changing landscape? I gave a speech at a conference a couple of months ago talking about the death of the ISO. And to our earlier conversation, like when I joined the industry, more than 10 years ago, people were already talking about this concept of the death of the ISO. If you were interviewing people in 2012, Stripe, Square, they're going to be the death of the ISO. And I think that the reality is the concept is right. I think the question is that on what timeline, are these events going to unfold? And I think a lot of the early predictors of that shift were absolutely spot on conceptually about the idea of this increase in the adoption of vertical software being, in a lot of ways, just a much better solution for a small business owner. So you as that restaurant are getting a point of sale solution tailored to your business. They have lending solutions. They've got all the dashboards that you need. They've got the integrations into the online ordering providers. They provide a full service solution for you as the restaurant owner. Same thing in the dental space. You go partner with a dental software provider that has an integrated payment solution. They've got all of the tools that you specifically as a dentist need to run your business. Whereas a lot of these ISOs have a one size fits all solution. They're targeting liquor stores, restaurants, salons, dentists, you name it. They have the same, hey, here's a basic terminal, that you use to run your business. They don't have a tailored solution specifically for, whatever that niche, SMB vertical is. Whereas these vertical software providers have really come in and provided a very tailored, very catered solution that adds significantly more value than, you as the ISO or agent just going and putting a VX520 or, Deja Vu terminal on their desk just to power the payments behind their business. And so there's this existential question of like, how does that distribution channel, which today is a significant part of the payments ecosystem, how does that massive, part of the payments ecosystem respond to the changes in how payments are going to be distributed to small business owners? I personally think there's still a tremendous amount of value that ISOs and agents can add into the equation. But the first step is for them to recognize that the industry is changing and then ask the question of like, well, how do I respond to these changes, that are happening in the ecosystem? And I think we're seeing it at Tild, where just in the month of August, we had 26 ISOs reach out to Tild, wondering how they could partner, how they could refer, software businesses to us, and how they could work with Tild, which was a record by a million miles in terms of the number of ISOs, waking up to ask themselves, that question. And so I do feel that people are understanding, this shift in the ecosystem, but I feel like it's going to accelerate tremendously over the next 3 to 5 years.
Yeah. All right. So basically people are going to go from offline knowledge and knowledge acquisition about the tools that are available to online. So then the concept of door-to-door sales is effectively gone over the long run. You might have, right? Like, I just don't think it makes like Stripe or merchant process, like it's expensive to send people door to door. So the only way that would be,
it's also expensive to acquire customers with Google ads and use them through Facebook leads and LinkedIn ads. And so I think, yes, it is expensive to send, an agent door to door, but a lot of the other, digital customer acquisition channels are very expensive, if not in some cases more expensive. Like if you look at the customer acquisition costs for companies like Toast, it's pretty significant. Yes, they're capturing more of the long-term residual revenue because those are our direct customers, but their customer acquisition costs are enormous.
Would you agree though that the trend is going to be software verticalization, such that if I'm a bike shop, I'm not even going to consider a merchant processor that's also selling to restaurants, like, because I need a piece of software to manage my shop. So that therefore I'm now looking at like 2, 3, 4 solutions at most. And what I really care about is not the rate of the payments, but like, can I have, various models of electric bikes? Can I sell online? Like I care about the management of the business. And oh, by the way, they have payments, of course. Yeah, no, but that's like an afterthought. It's really about, they're really comparing software based on the feature set, usability, pricing of the software, and then every one of them has payments integrated into it. But the acquisition cost there should decrease the more there is verticalization, because there's just less competitors that I'm considering. Does that resonate?
So I fully agree with the premise that if I am an SMB owner as a restaurant, as a bike shop, as a dentist, whatever vertical that I'm in, 5 years from now, why in the world would you be partnering with an ISO with an unintegrated terminal? I absolutely agree with the premise that integrated payments, vertical software is really the wave of the future from an SMB payments perspective. I think a question that I have in my mind is there a place in that model for an ISO or an agent to partner with that bike shop vertical software business to go sell it door to door to each of the bike shop owners? And so, my personal view is there is an opportunity for this distribution channel that's been incredibly successful for decades, distributing payment processing to small business owners, relatively low customer acquisition costs. It's a residual commission only model. I think what you're going to see is more and more vertical software businesses that are taking one of those two approaches. I, as the vertical software company, have developed a scalable digital marketing funnel. I don't need the ISO. I've got Facebook ads, LinkedIn ads. I've got an inside sales teams. We're crushing it. I think there are going to be companies like that absolutely scale, do a phenomenal job. I think there are other vertical software businesses that aren't as well versed on payments, that struggle to acquire those customers directly. We see it in our day-to-day business. There are vertical software companies on our platform that have no idea how to sell payments. They have absolutely no idea how to sell payments, and they would benefit tremendously from partnering up with an ISO, with agents that understand their vertical, that can help them get their integrated software product into the hands of as many of their target customers as possible. So I think that there's validity in both of those models. The commonality is that there's a vertical software company at the center of that universe. And that is a shift that I unequivocally believe you'll see start to unfold over the next 3 to 5 years.
There's a funny story about this, interesting. My first startup was in 2012, I started a web-based, like iPad-based point of sale business called Zing Checkout. And we were focusing on multi-location apparel shops. It was my co-founder was doing some consulting, software development for this company, Red Chapter, that made clothing. And he's like, they can't manage it in multiple locations. It's really hard. They do trade shows and all these things, like inventory management's a problem. So we built this thing on iPads. I was even doing door-to-door sales, trying to grow it and thinking about all these things that we're talking about. And one of the players in the space at the time was called Harbor Touch. And they basically they took this approach that we're talking about, which is like, instead of trying to sell payments, try to sell the machine, try to sell, like, they focus on restaurants. So they're like, we're going to sell you the devices, the hardware, like the screens. We're going to sell you the
Network,
software,
kitchen
the network,
display.
all of it goes together, and it's free. You could just take it. And the catch is that we're going to upsell on the payment processing. But for a business,
an exorbitant price.
yeah. But for the business, it's like, well, if it's free, that sounds great. I don't have to pay because I got all these expenses when I'm setting up my business. So they turn into
$10 or $15, $20,000 worth of equipment.
Exactly. This guy turns out to later on, I was like, the whole thing came full circle when I was watching SpaceX's maiden voyage on the Dragon. I think it was the Dragon mission where they went to the space station. Anyways, this guy funds the whole project. He like sponsors people to go in outer space from the proceeds from Harvard Touch. You know, they didn't really highlight that.
Ship 4.
Ship. Yeah, that's exactly right. I think it was SpaceX. I think I could be wrong on that. It might have been Blue Origin. I forget which one. But either way, he sponsored a space mission from the proceeds of packaging, payment processing together. So, there's definitely something there. So your business is Tild allows software vendors, companies selling into small businesses, the ability to upsell the payments. And Stripe currently doesn't allow this, or is that right? And strategically, why wouldn't they do it?
Yeah. So Stripe's typical model, they charge 2.9% and 30 cents for payment processing. And so in the early days, you as a software company integrate Stripe into your, bike repair software, you're going to pass through the 2.9% and 30 cents from Stripe on to your customers. And, why does Stripe not negotiate? The reality is they don't have to. They have established themselves as a market leader within the startup space where there's really not a lot of price sensitivity. These startups are more than happy to pay 2.9%, 30 cents, and pass that along to their customers because really at that point in their life cycle, they're focused on acquiring as many bike shops as they can and selling their SaaS solution to these bike shops. They're not really focused on the margins, the average revenue per unit, the unit economics. That's not the focus when you're trying to acquire your first 50 customers. Whereas once you start to scale, you start to look at, how do I generate as much revenue as possible from these customers, but also how do I create the best experience possible, for all of these customers. I think for us at Tild, yes, a core part of our solution is helping these customers better monetize all of their payments and generate this, recurring revenue stream off of every payment flowing through their platform. But we're also trying to help them improve their customer experience. How can our solution help you create a better overall experience for your customers, but also how can we help you scale it? And so for me, when I think about what we do at Tild, our platform is called PayFac-as-a-Service. We're providing a payments infrastructure solution. So these software companies are coming to plug in to our APIs and SDKs. They're integrating in a matter of weeks. They don't need to hire employees. They don't need to take on liability, but they're still getting this fantastic recurring revenue stream. And so technology is really at the core of what we do. But one of the aspects of our service that Stripe doesn't provide, sales and marketing support. And so we talked a lot about, how do these software companies actually scale? How do they get their product out into the hands of as many of their customers as they can? And for a lot of these vertical software businesses, they are experts in the dental space, in the restaurant space, in the retail space, whatever their core niche is, they are experts in that space, but oftentimes they're not experts in payments. And so when it comes to designing email campaigns, in-app messaging campaigns, landing pages designed to help convert their customers to sign up for their integrated payments product, they're not really experts in that. Mm-hmm. And so what we can do is we can come in and not only provide the payments infrastructure solution. So they've got white label onboarding, white label, merchant portals, they've got, all of the basics that they need, but it's also how can we partner with you to help scale your software company to as many of your existing customers, as many net new customers as we can. So I think that combination of technology, the core payments infrastructure, and then the managed, services to help you scale, in my mind, is a really key component of our Payfac-as-a-Service strategy, and really one of the ways that we really differentiate against Stripe, pricing aside, because we can blow them out of the water on price every day of the week.
Is pricing ends up being a insignificant thing, or is that like the reason why people leave? Do they typically leave Stripe and then go to somewhere else like Tild, or is it like big companies are thinking about this? I mean, like you said, most verticalized software companies, I mean, they have to start small, and then I imagine Stripe is what they intuitively use.
I do think that pricing is an important component where at the end of the day, these companies need and want to make money on, all of the customers that they're signing up. And so, if Stripe is not able to get them to a price point where their business can create the type of margins that they want or that they really should have, I do think that that's a pretty fundamental tenet. I think, a couple other aspects of, where Stripe struggles. I think from a branding perspective, Stripe is pretty big on pushing the powered by Stripe concept out to their customer base. And for a lot of these vertical software platforms, they really want to own that relationship with their customer and have their brand, front and center with all of the merchants in their ecosystem. And you don't want to have to do a ton of custom development work to be able to build in, all of the capabilities to have that custom branded experience to your customers. So having that turnkey white labelable solution is pretty important. And then, one thing that we haven't talked a lot about is like card present hardware. And so one of the fundamental reasons why so many software companies are researching, whether it's Tild or Card Connect or alternative options, a lot of vertical software platforms start with card not present online payments as their kind of method in the door to start, working with their customers. So take, a dentist, example, they start by just powering the invoices that the dentist may send out to their customers after the fact. So, hey, I didn't know what your insurance was while you were in person for your visit. I'm going to send you an invoice. You click this link, you pay. That's powered by Stripe. And so that's where a lot of these companies start. But what a lot of them realize is they start to scale and start talking with their customers, and their customers have confidence in that payment solution that they're providing for that card not present piece. They ask them, well, hey, I've still got this old terminal that, some agent walked in the door and sold me, 5 years ago. Can you replace this terminal? This terminal is actually where 80% of my payments volume, goes through today. And so the vertical software companies are like, well, hey, we're leaving, 80% of the money on the table on payments. How do we add in this card present, hardware terminal solution to our platform? And they go to Stripe. Well, hey, Stripe, what hardware options do you offer for me as a software business? So like, well, hey, here's Stripe Terminal. Okay, well, I don't like Stripe Terminal. Well, sorry, that's the only, option that we have, for you as a software platform. Now, I'll caveat this by saying they've just bought BBPOS. And so I'm sure if you look in the Stripe roadmap, the Stripe R&D, they're planning to solve for what I think is a pretty fundamental gap in their solution. But if you look at where they are today, that is a significant gap in their product offering for a vertical software solution that's looking to provide a full service solution to the customers, that they serve. And so I think that combination of the pricing, the branding, and then the card present piece are all, pretty important factors when you think about the differentiation and the competitive aspect of what we do.
Interesting. So yeah, people go to complain about the Stripe hardware. What is what is your pricing? What is Visa's pricing? I'm curious to learn more about pricing. It's 2.9 plus 30 cents is Stripe. What is where is Visa? Where's their, I guess everyone branches and adds on from there, right?
Yeah. So to kind of throw out some industry jargon here, Stripe uses what's called flat rate pricing. So 2.9% and 30 cents is what's called flat rate pricing, where you as the small business owner have no idea what the true Visa, MasterCard, Discover, Amex charges are, and you have no idea what Stripe's margins are. Mm-hmm. So that's the beauty of flat rate pricing, is that it's simple for a merchant to understand. They know I process $100 transaction. I know exactly what it's going to cost me. I know exactly what that $100 charge is going to cost me, $3.20. I just know 2.9%, 30 cents. The problem with that is that on average, it's substantially more expensive than if you're doing interchange pass-through pricing. And so interchange being the direct pass-through costs from Visa, MasterCard, Discover, Amex. And so these are the pass-through items. And the beauty of an interchange plus model is that I tell you what my markup is. I say, hey, I'm going to charge you 10 cents, 25 basis points or 0.25% and $8 a month. And so the advantage is that you as the small business owner know the cost basis, you know what Visa and MasterCard charge you because it's passed through. Mm-hmm. You understand what my markup is because I'm telling you up front, this is my fixed markup that I charge over the interchange plus cost. The struggle, and when you go back to the distribution model of door-to-door sales versus online, hey, I clicked an ad and I'm going to go sign up. most merchants intuitively have absolutely no idea what an interchange plus pricing model is. And so unless someone's in their business explaining to them, hey, here's what you're paying today, here's what I would charge you, here's what the savings are, they look at that and they're like, you're making these terms up. This is not a real thing. I have no idea, what you're talking about. Flat rate pricing is easier, for them to understand. But the reality of interchange plus pricing is that it really gives them the ability to have transparency and maximize the margins. And so for us, we pass through typically our wholesale interchange plus buy rates to the software company. We allow them to set the pricing to their merchants, to their customers. If they want to do flat rate pricing, they can. If they want to do interchange plus pricing, they can. And then our typical model is to rev share the delta between what that merchant, what that small business owner is paying, and then what the true wholesale cost of processing is. And so it's a full kind of open kimono, transparent model for these software companies where they know what our margins are, they know what the cost is, and they're able to control the pricing to their customers. And so it really puts them in the driver's seat over their model, over their pricing, over their margins to really be able to drive and scale that payments revenue opportunity within their business.
And is the pricing transparent? What if Stripe is 2.9 and 30 cents, where are you guys?
So in terms of our kind of typical cost, if you think about the average merchant paying 2.9% and 30 cents, usually there's about 80 basis points. So 0.8% of margin when Stripe is charging that 2.9% and 30 cents. And so if we're giving, a pass through of our wholesale cost and then offering, let's say 2/3, 66% of the revenue to the software platform, that's 0.5% or 50 basis points that software company is leaving on the table by partnering with Stripe. And for software companies out there, when you start to do that math, you're like, well, I do $100 million in transactions, every year on my platform. How much money am I leaving on the table? You're talking at least $500,000 in margin, that you're not earning across your current customer base, which for some software companies is actually equivalent to, if not more than their SaaS revenue stream. And so you're saying, well, hey, I could double my margins or more than double my margins, by adding in an integrated payment strategy. Like that is the practical reality of what a lot of companies have found by implementing an integrated payment solution. You look at the public examples of Toast and Shopify, they are making, in some cases, 4 times as much money on payments than they are on their core software product. It is a highly profitable endeavor to integrate in payments if you do it well.
Do you think it sounds expensive, 3% basically for a merchant to run their business. I would imagine some percentage goes to fraud. So people steal credit cards, they buy shit online, and then they go to the merchant and they say, hey, what happened? And it was fraud. And so now the credit card company or the merchant, usually the merchant, I believe, has to pay for that. And that is what, do you think Apple Pay and face recognition, fingerprint recognition start to eliminate, like push it to near zero credit card fraud, at least for in-person transactions? And does that have any effect, or is that is Visa, MasterCard just going to absorb that income as well, do you think?
Yeah. So oftentimes it is the merchant bearing the brunt of that responsibility for the cost of chargebacks. To the second point that you made, Apple Pay almost does eliminate fraud for in-person transactions. One of the huge benefits of encouraging merchants to accept more contactless and Apple Pay transactions. And so I definitely think that, when you look over the next kind of 5-10 years, there's going to be an acceleration and an interest from the card brands in trying to encourage different ways to help reduce fraud, whether that's 3D Secure, Apple Pay, some sort of biometrics, or there's a lot of different options for how you can create a more secure process for processing, card transactions. I think that the reality is that creates opportunities for companies to come in and create a piece of the pie. Apple Pay is highly profitable for Apple. I think it's like 15 basis points that they mandate any, issuing bank that operates on the Apple Pay network to leverage them. So that's a significant revenue stream, for them, but they're also providing a great service, for merchants where it's convenient. Me as a consumer, I love paying
Yeah.
with Apple Pay. And if I were a merchant, I'd much prefer to have 100% of my transactions,
Yeah.
run through Apple Pay, because you're substantially decreasing your risk of fraud.
I mean, they must, I don't know what the average fraud numbers are, but for in-person and online, I don't know. I would imagine online is higher. I don't know which one's higher, but either
Online's definitely higher.
online's higher.
It varies a lot depending on the industry and the business type. And so I think one of the things that, we see, given our kind of horizontal position in the space, is that there's a pretty big delta between different industries, when you look at chargeback rates and fraud rates. But there's also a lot of opportunity for these merchants. There's a lot of companies out there now that are targeting exactly this solution and providing, AI and ML based solutions to help counteract a lot of the typical risks that especially online merchants face processing transactions.
I'm surprised we're not already there with online transactions. Like when I go into a grocery store, and use Apple Pay, it's like Face ID, check, thing to thing. It recognizes all like completely automated. And then when I go to a website, I'm using all Mac hardware, and it's like enter your credit card. And I'm sure Apple is either working on this or already has it out, and I haven't upgraded yet. But it's like to have a fingerprint ID, like have the internet be entirely biometrically payment secured. That has to be a top priority. Is that something you're
Apple does have that capability. So you can integrate Apple Pay into your MacBook. If you've got a more recent MacBook, they do have the biometric scanners. So you can leverage for, websites that have Apple Pay enabled. You can leverage that technology. I think there's two things. I think one, there's an issue of like ubiquitous like technology adoption. And so that's where technology providers like Tild help more software companies, more merchants embed Apple Pay capabilities within their site. I think, thing two is like, what's the appropriate level of friction at that checkout experience? And that's something that I think a lot of merchants and software companies really struggle with, like the appropriate amount of friction in the checkout process, because if you get it wrong and you've got too tight of a rein from a fraud perspective, you're just turning down sales, and you're literally giving away revenue, and the losses that you would have had from a fraud perspective absolutely do not justify, the sales, that you lost. But if you have it too loose, then all of a sudden you're letting through a ton of fraudulent transactions, and, you're creating losses that were unnecessary. And so it's that balancing act of having the right level of friction and the right level of sophistication on your fraud engine to create that balance and that customer experience that is appropriate.
How come I've never seen any incentives for customers to use biometrics? Like use Apple Pay and get, save 1%, have some incentive on the customer side. Is that?
So I think one of the challenges is that the merchants today are the ones bearing the costs of credit card processing. And so it's like for me as a consumer, like, why do I care? And so for a merchant, like they're the ones that are incentivized. They're the ones that are paying the cost of credit card processing. They're dealing with, the chargebacks. For me as a consumer, it's a convenience. I get my cash back, by paying with my credit card. I get chargeback protection. I have all of these, benefits, but there's no liability. There's no cost. There's no concern. For me, I do think that where you're seeing this acceleration of dual pricing, cash discounting, surcharging, or some of the names, that are being thrown out there, it is encouraging consumers to be more conscious of what type of card they're using, in the checkout environment, where if it's a surcharging model, hey, if you pay by debit card, then we're not going to assess this additional 3% or 4% or whatever, crazy rate they're adding on for the surcharge. We're not going to assess you this additional fee. And so it actually makes the consumer aware for them to actually make that decision at the point of checkout. Like, hey, do I want to pay an extra 3% just to pay with my credit card? I personally don't. If I'm in that environment, I'm paying, by debit card, depending on what it is, that I'm buying. So I think you're starting to see, some of that behavior and incentivization creep in to the checkout environment, but by no means is it, ubiquitous in its adoption. I think there's a lot of merchants out there that are really hesitant to institute that dual pricing model for fear of, potentially, shunning away customers that don't like them, pushing that cost downstream.
So you guys have raised about 30 million. Is that right? And where is crypto on the roadmap? I mean, crypto provides incentives with faster, maybe not, maybe it's not speed. It's not going to be speed because the rails are really quick now. So it's going to be on transaction costs. You could trade on the Lightning Network for far less than 2.9% or some other chains as well. This feels like an inevitability, like the oligopoly of, Visa, MasterCard can't just sit there leeching off 2.5% on the world forever. Crypto, I've talked to some people who are like, this is their life's mission to integrate crypto into merchants. Are you seeing it on either the consumer side, the software side?
Honestly, no. And I think there's a couple of issues. I think one, from a consumer demand perspective, consumers are not yet really wanting to pay with crypto. For a lot of consumers, myself included, like I have crypto, but I'm holding it. It's an investment. I'm not really looking at this as, hey, I want to go into a small business and pay with my Bitcoin because I'm holding on to it. That's an investment. And so I think that the first problem that you have is really a level of demand and interest from consumers. And partly because of that, I don't think that you have a lot of technology and distribution right now to get the right capabilities to create that acceptance at the merchant level. And so just as Visa, MasterCard, Discover had to figure out how to distribute their product 30, 40 years ago to get it out of the hands of as many merchants as possible, there's this two-sided marketplace as well for crypto. So how do I create the demand, or I guess maybe the supply from a consumer perspective that I want to pay with crypto? And then you've got the other side of the equation. How do I make sure as many merchants as possible have the ability to have a frictionless checkout experience? Because if you, like me, tried to pay, for anything with crypto previously, like I can't even figure out how to do it. It's just a complicated, friction-filled, checkout experience. And so until you have, those two pieces of the equation solved, like the flywheel doesn't turn as it does today with cards, where you've got mass adoption from a consumer perspective. And it's easy. I just, hey, here's my card, or put in my fingerprint or Face ID. And so it's just easy.
Yeah. I think that's right. I think it's going to be an emergence in other countries first. The US is a pretty robust US payment system. It could also be pressure from the US dollar with inflation or, drastic inflation that people are like, okay, I want to move off this. But yeah, it's exciting. Good thing now to radar. Interesting to hear, you're not really seeing it in the market. Cool. Anything else top of mind? You want to throw out your personal Twitter or anything on the personal side? We'll have links for all the Till stuff.
Yeah, not big on Twitter. I think LinkedIn is really the place to find me. Very active on LinkedIn. So if you're interested in following, me personally, or learning more about, what we do at Till, LinkedIn is certainly a great place to start to get up to speed on what we do. And then shout out for Till website, TILLED.com. Fantastic place for both software companies and ISOs and agents interested in learning more about what we do. But Mike, really appreciate you having me on the podcast today. This was our inaugural recording in the Tilled podcast studio. So excited to finally put it to good use, and really enjoyed the time here with you today.
Yeah, this is fun. Thanks, Caleb. Chat soon.
Awesome. Thanks, Mike.